Here's a question for you. Are you too old to start investing? Does having too many grey hairs on your head mean that you're no longer eligible to start investing your hard-earned money? In short, no, it's never too late to start. Well, the best time to start would have been probably around the 2009 financial crash, or maybe even earlier, potentially just after the dot-com bubble, but in all honesty, no. The best time to start investing, if you haven't already, is now. It's exactly the same for anything that requires long amounts of time to work. Lewis Hamilton becoming great after years of work, from RC cars, go-karts to Formula 1. Tiger Woods missed plenty of shots before becoming a champion, and David Beckham hit plenty of balls through a car tyre to become the best free kick taker of his generation.
Yeah, I used to seem to take all free kicks, so I used to be able to whack a ball quite far.
Investing is no different, and it really requires a long amount of time to work for compound interest to take hold, and that doesn't really matter whether you're starting out at 20 years old or 60 years old. Of course, sure, you get some more advantages if you start earlier. You get to ride that wave of compound interest, you get to smooth out the highs and smooth out the lows, but as long as you've got a long-term time horizon, you'll put yourself in a very, very good position. Either way, it's best to get started today. If you ask any investor, professional, hobbyist, or whatever, I'm sure one of their number one tips and their biggest regret would always be,
I wish I'd started sooner.
Try and take some of that advice, and if you're still waiting on the sidelines by the end of the video, maybe get yourself started. So the whole idea of this video came from a comment on one of my most popular videos, which is talking about the best Vanguard portfolio I think you can make, which will satisfy most people and give them a great platform to build from. And the comment really struck with me, and here it is now. I'll pop it up on the screen. So in summary, what Kevin's saying here is he's 59, really wants to invest his money, has a 10-year time horizon, trying to work out what's best to invest in, a little bit put off by bonds, I can't blame him, concerned by the home bias of some of the funds in the Vanguard platform, like the Life Strategy, for example, and then also thinks the Target Retirement Fund is potentially a bit too inflexible. And of course, as we know on the Vanguard platform, we've got 76 funds to choose from. So I know personally how complicated this might be able to be, especially if you're not invested already. So when I saw that comment, I knew there would be a huge amount we've got to discuss here. And of course, there's loads of different factors that will come into play with how maybe we would put together an investment portfolio for someone like Kevin. So I thought, let's get together as a community, try and pull together, try and get some ideas, and maybe try and suggest the best path forward for Kevin. If you can think of any more advice once you read this video and you want to drop them in the comments below, I'm sure they'll be much appreciated. The more we can pull together as a community and the more we can share ideas, I think genuinely this will help us all become better investors and more consistent too. Right, so let's break this down one by one, point by point, and try and figure out what a good portfolio might look like for Kevin and lots of other people in a similar situation to him. So here are some of the assumptions I'm going to work on, because of course, personal finance is just that. It's incredibly personal. And of course, I don't know his situation. I don't know everything else that surrounds that. So I'm going to make lots of assumptions in this video. Please do seek professional financial help if you need it, because that is not who I am. So firstly, let's assume that we've got an emergency fund set aside. That will cover all of life's emergencies, anything that comes up that we need an expense, just so we don't ever have to sell these investments, so we can make sure that we're fully invested during the whole time we've got. Secondly, we've got a 10-year time horizon to work with here, so that's really, really good and will enable us to weather out some of the storms, because of course we never know if there's going to be a correction or a market crash over the next few years, but 10 years will give us a really good amount of time to make sure that our money grows in that account. Thirdly, we want to make sure that we're maximizing our growth, but of course not taking too many risks, because as Kevin highlighted quite rightly, he's not going to get another chance to get this right, and because as you get older, you don't really want to see your money start dipping and losing power. In number 4, I need to make sure we're only using funds from the Vanguard website, so we're going to keep things really simple, and I'm not going to touch on any individual companies here because I think that's way too risky. We're going to stick with some nice simple funds and ETFs. In number 5 for me, I'm going to avoid bonds and fixed income. Bonds I think have potentially been a really good tool in the past, and of course you could have had a nice balanced portfolio with maybe 60% equity and 40% bonds in the past, which would have helped you when we've had certain market corrections. But I think in the current climate we're in, I can't really see things changing over the next 10 years where bond yields are going to improve. So for now, I'm going to assume 100% equity to give us the best chance to grow, because we know that equities and stocks have outperformed all asset classes over the long run. And finally, I will assume that we'll go for a lump sum investment, but of course, this is all down to personal choice, and you'd be very welcome to maybe invest over a few weeks or a few months, or even up to a year for that 10-year horizon. But let's just remember that ultimately lump sum does win most of the time, and I did a video about this recently which you can check out after this one. So if we go back and see what I did in my last Vanguard portfolio video, I was talking about potentially making a fund for everyone which would basically cover the world, and you can do this in a number of ways. In the first option, I put together effectively a developed world fund with an emerging market fund and then weighted them according to their market size. So from memory, I did a developed fund around 88% and I said emerging markets, we put 12% of our money in. This gives us a really super low cost, broad, diversified investment that we can just pretty much invest in month by month or big lump sum, and we're good to go. I also then gave a second option that says, rather than trying to make your own emerging markets and developing world fund, just invest in the FTSE All World UCITS ETF, which is ticker symbol VWRL, which is an extremely popular global fund. Of course, the benefits of having a single fund would mean that you don't have to balance things out. Because of course, in the next 5 or 10 years, for example, because let's say you end up in a position where you end up with 30% in your developing markets and 70% in your developed markets, then you may want to weight them back to that 80-20 split, depending on where they are. Otherwise, you could end up with a bit of an imbalance. The question we really need to figure out though and get the answer to is that portfolio really something you'd recommend to a 59-year-old compared to a 30-year-old? And really, does age even play a factor in this? Would a 30-year-old choose a different set of funds versus a 59-year-old? And really, after a bit of deliberation, I came to the conclusion that whether you're 30 years old, 59 years old, or even 70-year-old, this portfolio would still be useful for you because it ticks a huge amount of boxes, and honestly, I probably wouldn't change it. First things first, we want a global diversified portfolio, which this option gives us. It gives us exposure to all the main markets, the US, the UK, Europe and emerging, and then of course that spreads our risk amongst the whole world, which means that when some sectors are doing well, we make sure we cover ourselves. And then on the other hand, when some sectors are doing badly, of course, we've got that hedge and we've got that leverage across the whole world. Furthermore, we avoid some of the overweighting that we get in the life strategy funds, where of course it's putting the UK market and providing your funds into the UK market around that 20-25% mark, when actually the UK only makes up 4% of the global market. And of course, as we know, FTSE 100 is a little bit of a boring market at the moment. Secondly, because we've got a 10-year time horizon here, as far as I'm concerned, that's a long-term investment. You'll hear lots of different traders talk about long-term investing being a minimum of a 5-year time frame. So having 10 years for me means that we're going to have plenty of time to ride out any potential corrections, and hopefully by the end of that, we'll have a nest egg which is a lot larger than what we initially put in due to compound interest and of course that corporate profit growth. Thirdly, I don't see any need for bonds. Now drop me a note in the comments below if you think any different, but at the moment, because bond yields are so low and I don't think they can have the same power as they have historically to potentially balance out a portfolio, I would say that we should just go for whole equities and of course make it 100% cover the world. That gives us a really nice, broad, diversified base. I just can't wrap my head around right now why you'd hold any asset knowing that it's not even going to beat inflation when there's potential lots of other things going better out there. And of course, holding cash or a very high interest savings account, it's not going to get us anywhere either at 0.whatever% we're being offered. And then finally, I said it doesn't really matter whether we lump sum or dollar cost average here. We do know historically that lump summing an investment works out about 67 to 3/4 of the time as a better investment than dollar cost averaging over that same period. But of course, the biggest assumption there is that we're investing over a longer period of time. And in all honesty, the lump sum investor doesn't actually beat the dollar cost averager by a significant amount. And it really then comes down to your personal risk. So on this side, I'll say completely up to you, completely up to the way you want to invest. Might be best lump summing everything in statistically during the past. It might be also best just going weekly or monthly, whatever you're comfortable and whatever your own risk level is. And that's pretty much everything I considered. I thought I can't really see why a 59-year-old would potentially be much different from a 30-year-old in terms of what their long-term investing goals were. We're not interested in speculating in individual stocks and individual companies, individual countries or sectors. We just want a broad, diversified index fund, which of course have proved itself time and time again through history. And then of course, it's much better than having that money sat in cash. And really, it's not too late to invest. Now, just playing a bit of devil's advocate, I thought about alternatives. I said, yeah, sure, we could just use the S&P 500, for example, because of course, the American market is 60% of the global market, some of the world's biggest companies who of course do business globally. But then I thought there's not a huge amount of downside really having a global fund, just in case that market doesn't outperform. And of course, I know it's the gold standard and it's one that I invest in heavily myself. But of course, as we get later on in life, we want to reduce those risks potentially. So of course, having a global fund, of course, might have its benefits over just holding the S&P 500. And of course, we've got to talk about currency risk as well. So I thought going down the global route rather than saying S&P 500. But in all honesty, in 10 years, they're probably going to be about the same place. And then my final point, the final thing that I was thinking at the time was, How else can we make this investment a bit more interesting? Or is there any way we can get some additional growth? And of course, this one's all going to come down to your own risk tolerance and your own risk profile. But in my opinion, I would potentially get a bit of cryptocurrency in this mix as well, for a couple of different reasons. Now, I may be being naive in this, but of course, bonds or holding gold, for example, just isn't something I'm really into. So you'd have to let me know in the comment section if you disagree. But I would say potentially, depending on your risk profile, you may want to take around 5 to 10% of that investment pot and potentially split it between maybe cryptocurrencies like Bitcoin and Ethereum. Over the long run, although those assets might be incredibly volatile, I'm incredibly bullish on the possibilities of cryptocurrency over the next 10 years. And let's say if this asset 5 or 10x's, that could add a nice little chunk of change onto a well-diversified VWRL fund. And of course, that'll really help in our old age and really give us a nice lump sum to play with. In the cryptocurrency land, Bitcoin, of course, is a deflationary asset. We know it's a great hedge against inflation. We know ultimately has a very good chance of replacing gold, which people have historically moved to as inflation has risen. And of course, at the moment, we are always concerned with the amount of money printing. And of course, currencies like the US dollar or other currencies around the world can just be printed into infinity. And we really need to hedge against that living cost. And I think Bitcoin does that really well. But again, this is all going to be down to personal risk profile. I'd love to hear your opinion down in the comments below. What do you think? And then if we just quickly talk about Ethereum, of course, I think this network and this cryptocurrency has a huge way to go because of course it's the foundation of decentralized finance. And of course it's supporting all these interesting crazes at the moment, NFTs and peer-to-peer lending. And I think this network has huge potential to grow. If we just look closely at the number of developers who are jumping on board and the potential that this market has to be, the adoption rate is insane. It's something I personally do, but then that's just my personal risk profile as a 32-year-old. I am quite heavily invested into cryptocurrency and it is slowly weighing up in terms of my investment portfolio. I'm probably around 15 to 20% now in Bitcoin and Ethereum, and I am absolutely 100% prepared for that number to become zero if I were to lose everything. But honestly, I think there's a huge possibility that there's a massive amount of growth over the next decade in that space. But anyway, let me know what you think. And I'm sure there's a ton of people watching this, and I'm sure there'll be a ton of people who are going to be in the exact same position as Kevin. And I'd really love to know what your thoughts are. If you've got a lot of cash set on the side, you've been a diligent saver throughout your whole life, you've always maybe wanted to get into investing, but you've never really taken the leap because you've always seen the bad news, you've always seen the red numbers. And of course, there's a huge amount of scaremongering going around. But then of course, you know ultimately that you need to do this because inflation is eating away at your money every single year. And although your savings pot goes up because you might contribute to it every month, the interest rates you're getting are really, really poor. So I've got to try and put my head in that sort of position. And I know from my position from being sold out of the market numerous times, incorrectly of course, how difficult it is then to get the mental strength to buy back in because you're always thinking you're buying more expensive and you're always fearing the worst. It really is always a tough one, and it just shows how personal finance is. And it really all depends on what's going on up here as well as the global economy. So it's a really, really difficult one. Always going to be a balance of risk. It's always going to be a balance of what your needs are, how long your timeframes are, and how much you can stomach. Anyway, good luck if you're just getting started. Please make sure you check some of my other videos out that I've tried to build out different portfolios. I am a customer on Vanguard. I am going to be building out my Vanguard stocks and shares ISA shortly. I'm moving quite a bit of money along from my Hargreaves Lansdowne account, which is where a majority of my holdings are. I hold a SIP, stocks and shares ISA, and I do have a general investment account. I've also got plenty of cryptocurrency with Bitcoin and Ethereum. And of course, I do hold individual stocks and shares too, and some US and UK companies. Anyway, as I've said many times in this video, please do let me know in the comment section below. Let's kind of bat some ideas around together. I'd love to hear your thoughts. Drop me a like if you found the video useful. If you'd like me to do some more different scenarios, please let me know. Subscribe for more, and I'll see you guys in the next one.